ETF cash flows finished the summer strong and are on pace for another record year. Hi, I'm Brad Collins, a specialist on our fixed income product team, and this is ETF Perspectives Quick Takes. The ETF landscape has been nothing short of dynamic in recent years, and Q3 of 2025 was no exception. For the second quarter in a row, ETF assets rose by $1 trillion. Equities continued to set new highs, driving industry growth, but new money accounted for nearly $400 billion of inflows. This puts year-to-date flows on pace to surpass last year's record of $1.1 trillion. The top asset classes in ETF cash flow range from broad market stocks and bonds to digital assets and treasury bills. Fixed income flows had another strong quarter, with ultra-short and core bond products continuing to lead the way. Most notably this year has been the demand for ultra-short bond ETFs, number one in cash flows year to date, and now the second largest fixed income ETF category by AUM, just behind core bond. Finally, active ETF inflows continue to dominate the headlines with $135 billion last quarter and $336 billion year to date. Up next, ETFs continue to launch at a healthy rate, and active equity ETFs are trending. What's behind this? ETF Capital Markets Director Dave Sharp fills you in.
This quarter spotlight on equities shows that ETF launches are still coming fast and furious, and active equity ETFs are becoming increasingly popular. Hi, I'm Dave Sharp, a director on our ETF Capital Markets team. ETF launches have been on the rise ever since the ETF rule was created in 2019, and they continue to accelerate. Almost 3,000 ETFs have launched since 2021, and 2,500 of those are still on the market today. A lot of that launch activity has been in active equity ETFs, which account for 1,200 of those launches. As we look at what type of active equity strategies are launching, a large portion has been in the derivative income and defined outcome variety that have taken the industry by storm the past few years. Creeping up the last 2 years, though, has been traditional fundamental strategies. These have been common in mutual funds for decades, but issuers are finally getting more comfortable with the ETF wrapper. We attribute this growth in fundamental strategy ETFs to these critical drivers. On the demand side, investors are favoring lower cost options, and most of the strategies coming to market and attracting the most flows are also embracing this. Second, ETF issuers have confronted the perceived challenge of daily transparency because of the many benefits the ETF provides. Issuers have adapted their strategies to not reveal too much intellectual property or to deal with adverse conditions in their trading strategies. Also, the increased desire for tax efficiency inherent to the ETF structure has been a primary driver of the success of index ETFs and will likely continue to fuel the interest in active ETFs. Finally, the growth of model portfolios has increased the demand for ETFs. ETFs work very well within models, especially when rebalancing. Rebalancing a model of mutual funds can lead to cash drag, as the model can't use the full proceeds before NAV is struck, whereas models that use ETFs can immediately know the full proceeds and invest it. All of these drivers may indicate that the market may have simply been waiting for active management to evolve in the ETF wrapper. Up next, year-end is fast approaching, and that means advisors are setting their sights on tax loss harvesting opportunities. Where do the biggest opportunities lie? Brad Collins has the answer.
As year-end fast approaches, tax loss harvesting is top of mind, and the proliferation of ETFs across asset classes helps make the process more convenient. The ongoing bull market in equities has limited the availability of tax losses this year. However, we still see opportunities in fixed income, particularly in long-end municipal bonds and treasuries. This is where steepening yield curves had led both asset classes to underperform over the last year. Recent weakness in labor market data and the anticipation of Fed rate cuts has driven yields lower in Q3, reducing available losses. And this just further emphasizes the importance of timely action. When executing tax loss harvesting, it's important to consider the wash sale rule. While you should always consult a tax professional on your circumstances, here are some ways to successfully harvest losses while attempting to avoid triggering a wash sale and maintaining portfolio exposure. First, consider switching management styles between index and active. If you're carrying a loss in an index ETF, you can harvest this loss by switching to an active ETF with similar characteristics and exposure, or vice versa. Next, there's no shortage of ETFs by category today. You could consider swapping ETFs between issuers, but also prioritizing product differences like benchmarks to help avoid triggering that rule. Finally, advisors often obtain asset class exposure using multiple ETF building blocks. Combining building block exposures into a single solution, or vice versa, separating a single solution into blocks, can help enable tax loss harvesting. Taking any combination of these approaches lowers the likelihood of triggering a wash sale and supports efficient, tax-aware portfolio management. Up next, Dave is back to dive into the benefits of ETF trading and how to best avoid excessive trading costs.
The tradability of ETFs is often cited as one of the top benefits of ETF innovation. But with that, it means investors need to pay close attention to trade execution. In April, we saw market volatility pick up substantially for more than a week. The cost to trade financial instruments increased substantially across the board. In just a matter of days, the spread cost on an average bond increased 15 basis points, but the spread on Vanguard bond ETFs only increased around 3 basis points. This shows that the ETF really helps to dampen trading costs in times of volatility. If you can, avoid trading on these days altogether. Also, the surge in newly issued ETFs means that investors should plan their trades with an eye toward avoiding unplanned transaction costs. New ETFs take time to establish liquidity in the secondary market. If you submit large trades as market orders during this time, you are more likely to receive a poor trade execution. This example of a new ETF illustrates this. You can see when trades are executed at times throughout the day. Those moments where the price deviates significantly from the average price of the day are examples of market orders that were too large for the market to handle. This led to a sudden change in market price before reverting back to its fair value. You can avoid this by using limit orders and submitting at a price near the ask for buys and near the bid for sales. These examples show that advisors can control transaction costs by using strategic trading practices. Always remember to place a limit order to avoid a poor trade execution. And with that, on behalf of Brad Collins and myself, I'd like to thank you for joining us for the Q4 2025 ETF Perspectives Quick Takes. You can read the full issue of this quarter's ETF Perspectives by clicking the link in the post. We look forward to seeing you again next quarter.